Stream it now at salemnow.com. salemnow.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Well, welcome back. It's been interesting. Actually, last week was really slow. You could tell that a lot of people in Wall Street were taking time off. Markets were kind of basically fairly steady. They ended up almost where they began at the beginning of the week. I would probably expect the same sort of thing. We've got on New Year's Eve coming up here. Coming into the new year, and I'll tell you what, I will be really glad to be coming into this new year. When I look around, I listen a lot to financial media just to kind of keep up with whatever the public is listening to and whatever kind of material they're publicizing. And what I see is that you're getting just a ton of these people, and this is not new, by the way, but they're looking at the past year and saying, hey, this is a one-year high. Now, the stock market made a new one-year high. And very few markets, I think the S&P 500 barely passed its old high that was reached several years ago. Okay, and that's kind of my point here. When I've got the Russell Mid-Cap Index Fund up. Size, mid-cap stands for medium size. Size, the smaller the companies are, historically, the faster they've grown. Over the past 10 years, that's not necessarily been true because you've got companies like Google and Amazon with the ever-evolving internet. They've been able to, actually, they've been pushing the evolution of that quite a bit. So they've had higher than normal growth rates from really large companies. That's the first time we've seen that in the country's history, actually. There was a Nifty 50 back in the 60s and 70s that people used to like to talk about. Our new Nifty 50s are basically technology stocks, Apple, NVIDIA, a lot of different names, most of them having a lot to do with technology. So if you take those stocks out of the index, it drops like a rock. Yeah. All the old-fashioned stuff just hasn't been doing that well. Look at Colgate-Palmolive, and I'm sure people are still washing their dishes, but it's down 6.3% from where it was in 2021, and it's actually back to the same price that it was in 2018. So that's Colgate-Palmolive. So I guess what I'm saying here is that it's been really tough on a lot of funds, the stock market in general. Even the companies themselves have had a hard time. Google is still slightly below the highest level that it reached in 2021. So why am I bringing this up? The reason I'm bringing it up is I hear people that catch a piece of some news, and it's upsetting to them. And I've got news for you. The media, apart from this show, is really they have to get your attention. Because if they can't get your attention, if they can't get clicks, if they can't get views, if they can't get listeners, they can't sell their ads, and that's their business, selling ads. So whatever they got to do, they justify that, and I'm not on board with that, but that's me, and it's basically the way things are. So just have to learn how to deal with it. And so looking at Google, Google peaked out. Oh, it looks like November in 2021. We're actually going into 2024 now, and it's still down 7%. And that's one of the better performers. That's one of the better performers. So, in other words, when you're looking at, it's very frustrating to look at your statement and seeing that, hey, these things have not made a whole lot of progress over the past 4 or 5 years. And I'm going, yep, that's about right. They haven't made a whole lot of progress over the last 4 to 5 years. If you go back over the past 10 years, it looks a little better. If you go back over the last 20 years, you go, wow, that looks pretty good. And that's one of the reasons people in our industry are always trying to convey the idea that you should be looking out over an extremely long time period, not over the next 12 months. That's not a long time period. And if you're looking out over the last 12 months, one of the main deterrents to getting good long-term success is concentrating on short-term stuff. Now, today, unlike 4 or 5 years ago, if you are not, you don't have to have all of your money in stocks to get a decent return anymore. Yeah, since the interest rates have come up quite a bit, one of the short-term bond funds I'm using, I really like it. It's the yield on it's about 5.5%. That's pretty good. That's net, by the way. So it's a big fund. It's a huge fund actually now because when you have that type of interest rate and you look in and you see that the average holding is going to mature in less than a year. Well, that's short term. Why is that important? Because longer term bonds, which have a tendency to pay a higher interest rate, why? Because you're willing to hold on to it, or supposedly willing to hold on to it for a longer time period. You get rewarded with higher interest rates. That's how it's supposed to work. Doesn't always, but that's basically how it's supposed to work. The longer I agree to hold it, the higher the interest rate's going to be. You might be thinking, yeah, but I bought a fund. I didn't buy the individual bond. Well, if you bought the fund that's buying those bonds, guess what? You bought those bonds. And if those long-term bonds are there and interest rates go up, that'll drop quite a bit. I mean, it'll go down tremendously. In fact, one of my, just looking at the aggregate bond index, okay, this is an index kind of like the S&P 500 is to stocks. There's an aggregate index for bonds, and there are actually 2 funds that try to mirror that as close as humanly possible, and they do a great job. One of them is Vanguard. The other is the Barclays teamed up with BlackRock to do this. So you've got 2 out there that try to mirror the bond index, and both of them are down double digits from where they peaked in 2020. Now, that's the price. If you were to have reinvested the dividend, you'd have a small gain, super small gain. But the price on it alone is down about 17% or so. And that's a lot. I mean, to be down 17% after nearly 4 years, wow. And getting a whopping, 4 or 5% income over that time period. If you spent that income, then your principal, you've been watching it drop and it's down about 17%. If you were reinvesting it back into that fund, well, you're almost breaking even. Lovely. So that's kind of where we're at. The stock market's not undervalued right now. Hasn't done all that well past couple of years, and it's still not undervalued. So where do you go? Well, that depends on your age. It also depends on a whole bunch of other things. How much risk are you really willing to take? We're going to talk about that a little bit later in today's show. How to evaluate what kind of risk taker you are. And I've got this relatively simple methodology I developed years and years and years ago, and I was so pleased. I mean, forever the my industry would publish this stuff. You better not be taking too much risk with your clients. You better make sure that your clients understand the risk they're taking. And they gave no instructions on how. What would satisfy the federal rules and laws that are in place? How do you clarify, what we should be doing based on somebody's current situation? They gave no guidance for that. They still don't give any guidance. Their guidance is, well, you've got to act like a prudent man would. Okay, first of all, my experience is women are better investors than men. I'm telling you.
At RBC Wealth Management, we are proud.
I guess it's time for me to take a commercial break here. Okay, so anyway, I just lost my whole train of thought there. So I'm hearing a message blasting in my ears. I'm not even sure if you guys could hear that, but anyway, you really need to sit down, and this is the hardest part of investing, is deciding how much risk you want to take. Everybody looks at the return. That's the return I want to get. Well, you're going to be surprised by how much risk you have to take to get a return that's only a few percentage points. I mean, it's not even 10%. To get returns that are between 5 and 10%, you're going to have to watch a fairly significant amount of fluctuation in your portfolios. And when I say fairly significant, it's a lot. And this is one of the few shows that ever really talks about that. I've been talking about it forever. And I know why major firms don't want to really go into this in that much depth. And I do. I think you should know exactly what you're getting into. The first time, from March of 2000 to March of 2010. Look at what the S&P 500 was doing. It was at the same place, roughly, and that's just mind-boggling. And by the way, during that time period, it had been down over 50% twice. That's just, and if you reinvested all your dividend, by 2011 or 2012, you would have been above where you were in March of 2000. And that's just not, that's fine if you're in your 40s or early 50s. You start getting up closer to 60s, you probably want to start backing off, using relatively short-term, high-quality bond funds. One of the reasons I started talking about the annuities, because they're guaranteed rates, and basically the prices don't fluctuate. They have penalties if you just cashed everything in and said, "Hey, give me my money back." And that's one of the reasons that a lot of people don't like it. And I'm looking at it and I'm just thinking, you know what? I think the maximum penalty I've ever seen was 10%. Now, I'm sure there are some out there that have higher than 10%. I've just never looked at them. Just didn't have an interest in it. I think the ones that I use are around 9. That's if you got out of it too early. Typically, you're going to need to hang on to all or most of the account for about 9 or 10 years. But you can take out, every annuity is different, but you can take out up to 10% in the vast majority of them if you needed to without any penalties. So that gives you some flexibility there. And there's a bunch of other flexibility that I think a lot of people don't really look at. That are looking at these products, and as soon as they see that, oh yeah, if I get out, I'm going to have to pay a penalty. Well, maybe not. It depends on how you're taking it out. And there's a reason that they're willing to guarantee higher rates for an incredibly long time period. And One of the reasons is they're investing in very long-term investments, so they're matching that up. If you do decide that you had to go out early, it might cost you a little bit of money. And I don't think it's not a ton, particularly when you look at how much the stock market moved by. I mean, that's the thing that really cracks me up. Would you rather pay a 8 or 9% penalty? And those are typically pretty high as far as penalties go. I'd say the average for the average product out there is probably 10 during the first few years, but then it does start to go down each year longer that you've had it. Would you rather pay something less than 10% or watch your money, in December of 2021 in the S&P 500 drop by 25% and then have to sell it? People don't really think a lot about that. Yeah, what happens if you had to sell your stocks and they just happen to be down? You can't guarantee stocks. You can. There are these things called put options. And I'm just going to tell you, it's like buying insurance on your fund. The amount that they charge for that is so high that if the market were to stay or even go up about 3-4% a year, you'd still lose money. That's how expensive portfolio insurance can be if you try to do it yourself. And I know because I used to. I was doing it before the fees got so high, and it was actually doable. You could actually, it might cost you 3-4% a year, but back in those days, stocks were averaging 9-10% a year. It wasn't a smooth 9 or 10. It was one, you get 1 year where it's up a lot and the other year where it's down a lot. Same thing it's doing now. But the cost of insurance was significantly cheaper than it is today. So I've got about 60 seconds here before I got to take a real quick commercial break, or actually less than that. This is Bill Bullington. I'm here every Saturday morning from 11 to noon. If you'd like to talk to me, you can set up a phone conversation or a meeting in the office by going to my website. There's a contact us form there, and I'll be glad to try to call you back and set that up. And with that, I'm going to head off into the commercial break, and I'll see you on the other side.
I'll never be more loved than I am right now. Wasn't holding you up, so there's nothing I can do to let you down. It doesn't take a trophy to make
No doubt about it, we're spending more time at home, which is the perfect time to make it more functional and beautiful. Hi, Ed Flash Ferentz here for Artistic Renovations, Northeast Ohio's premier and award-winning remodeler. Artistic did a fantastic job with our kitchen in 2016, and last year, they were back for the master bath. Oh, my word. Do yourself a favor and go to artisticreno.com. Believe me, you'll love their ideas and without question the finished product. For a virtual consultation, call 216-520-0838 or visit artisticreno.com.
The straight-talking, hard-working, do-it-right plumbers at Wyatt Works will unclog your drain for only $93.
Or it's free.
What's the catch?
There's never a catch with Wyatt Works. I'd rather starve than do business that way.
We really will break up your clog and get your water flowing again for $93.
Plus, we'll send a camera down the line so you can see exactly what you're dealing with.
Most of the time, clog busting's all you need. Wallakadoodle. Back to your regularly scheduled life with a 12-month no-backup guarantee.
If your drain line needs more, we'll explain all the options, including flexible payments and guaranteed estimates.
And on the off chance clog busting can't get your drain flowing, our service call is free.
You'll still get upfront pricing on solutions to your problem, but with no initial service fee. That's on us.
Either we deliver on our promised clog busting, or it's free.
So don't put up with half solutions or slow or clogged drains.
Call Wyatt Works and
consider it done.
License number 30185.
America is kept safe because the Army National Guard responds, protects, and supports our nation when it needs them most. The Army National Guard responds to disasters such as wildfires and floods. They protect us with missile defense, cybersecurity, and civilian support teams for chemical, biological, and radiological hazards. Be there for your community and your country. Visit NationalGuard.com to learn more about part-time service. Sponsored by the Ohio Army National Guard. Aired by the Ohio Association of Broadcasters and this station.
Thinking about updating
your home? Well, Joyce Factory Direct specializes in replacing old, outdated windows. Proudly made right here in Cleveland, Joyce Windows features their exclusive Smart Shield high-performance glass, which means you'll be getting the most energy-efficient windows for your home directly from the factory. Customers just love how much warmer their house is and how easy their new windows operate and clean. Right now, you can save 50% on all installations. Just call to schedule a free consultation with on-the-spot pricing, 440-243-5700, or visit joycefactorydirect.com.
SOS, I'm a castaway, trying to make it back home. Hope is far and I'm losing faith.
And welcome back. This is the Bullington Capital Report. This is Bill Bullington speaking. And if you'd like to, you can call in today, by the way, 216-901-0945. If you have a question. If you'd like to ask me a question, but you don't want to do it over the radio, I understand completely. You can go to my website, bullingtoncapital.com. You can either send a question in through the filling out the form. Incidentally, I get an awful lot of people that sign up or send me questions, and I'm assuming they probably just want to sign up for the newsletter because they forget to write the question in, or they didn't want to write a question, they just wanted to get the newsletter. And you are more than welcome to do that. I send out a little newsletter. This week there were like four or five articles, I can't remember, but I get these selected and presented to me. I get to pick which ones, and I get to edit the text that goes out. So I do that on a weekly basis. And, there's been a lot of stuff in there I've really liked. In fact, one of them was withdrawals. We were talking a little bit about how different accounts are taxed, and we're looking at 401ks and Roth IRAs and IRAs, and there are a ton of options now. I mean, it is mind-boggling. Where does Congress get all this time to write all these rules? I mean, it's mind-boggling. Yes. So you have a ton of different things that you can do. And people, just in the past couple of years, I've been looking at these 529 plans. It used to be such a simple item. Now it's incredibly complex. Now you have Roth IRAs, and Roth IRAs. Not everybody can have one, but you might qualify for a conversion if you didn't qualify to make contributions to them. And the world's always changing, and I don't know. It's a lot of change. I'm kind of glad I do what I do because I get to see it. They keep coming up and say, "Hey, you got to know this," and it's a lot of effort, though. I mean, I spend an awful lot of time just reading and studying just to try to keep up. So, but I wouldn't have it any other way. I kind of like it. There's a lot of satisfaction that comes from that, especially when you find something that really helps somebody out. Speaking of helping people out, a couple of years ago, I started talking about the fixed indexed annuities, and some people started getting a little upset that I'm talking about annuities because they just like stocks. Well, that's fine. That's not for me to say. If you don't mind, having a like where S&P 500 peaked out in 2021 and is just now getting back to the level that it was over 2 years ago, and being down 25% in the meantime during that 2-year period, great. And then, I've got a huge chunk of my money in stocks and stock funds. And I believe over the next 10 years, I think 10 years from now, it's probably going to do better, or I hope it does better than the guaranteed portion of the account. But that balance is kind of that's the trick, finding the balance. And that's one of the reasons you'll never hear me say you should always do this. That's never going to come out of my mouth. Why? Because everybody is different. Everybody's different. When a couple gets ready to start planning for retirement, it's getting closer. They don't have the same attitudes towards investing, and they may have actually may have, this happens quite often. In a married couple, one of the spouses is more aggressive than the others. They're not the same. Occasionally they are, but in most cases, there's going to be a difference there. One of them likes to be more aggressive than the other one. That can become a problem if it's not talked about. At least just a minor discussion. You don't have, doesn't have to be a really long one, but the bottom line is, if you're expecting to earn returns in the high single digits, like 8, 9, 10% a year, and you're expecting to do it with little or no risk, well, that doesn't exist today. That doesn't exist. You're going to have to invest in stocks to get a shot at generating those types of returns. The problem is the stock market fluctuates a lot. To generate those types of returns, you're going to have to be willing to see the money that you've invested into those funds drop by 40 or 50% at some point in time. I'm not saying it's going to happen tomorrow. I'm just saying if you're going to live longer than 10 years, there's a pretty good chance that you're going to see that again. So keep that in mind. And that's what's difficult. That's the difficult part of building portfolios. It's not building a portfolio itself or having knowledge over anything, or even like I have a model I like a lot that's aggressive. It goes into healthcare and semiconductor funds. So the funds I'm using, I feel like give me the best coverage, complete coverage for those two industries. Why am I using those? Well, because the growth rates in the companies inside those industries are some of the fastest on the planet. And the faster a company grows its sales, basically its business, the better the share price has a tendency to do over time. So, and I focus on those, and it's not mandatory. These are the kinds of conversations I love to have. Hey, I understand you want to take some of your money and you want to put it away and be very conservative with it. I get that completely. And then other money you want to take it and you want to have some more, you want it to be a little bit more aggressive because you like to make more money. I understand that too. Here's a combination. Here are bunches of combinations, and you get to pick. So I think it's a really good way of being able to kind of keep your finger on the pulse too, because I'm doing the same things you guys are doing, probably not in the same percentages, and most people are not quite as aggressive as mine is. I think I'm probably around 25 or 30% fixed income, and the rest of it in those funds. I have a small portion of it that I put in individual stocks, and I keep saying I'm going to keep talking about that, and I keep forgetting to write the scripts for it. But actually, by the end of today, there were some companies that came up on the scans that I like to look at that look pretty good, both from a valuation standpoint, and valuations are really low on a lot of stocks. And but you have to understand, these are stocks. The valuations can change. Their business models can change. They can just be the victims of bad luck. But anything can happen, and probably will. What I like to say. So we'll come back to that a little bit later. But kind of circling back around to the guaranteed income portion, I think that with the rates that you're being offered today in these products, and I've been saying this over the past 4 to 5 years, and it's still true. And I bought mine 4 years ago now, and the rate, if I were to buy it today, is going to be a little bit higher. So that's good. I'm glad I didn't put all my money in there. I can always buy another one. I'm actually the end of the first quarter next year. That's my plan. But the rate's still really good. And somebody coming in today, I'm just going to make this illustration up. So somebody who is 66 years old and is going to be full Social Security age next year wants to know how much could I get if I put $100,000 in there? Well, according to Nationwide. And if you want to or if you want to go to this website, just hit me up with an email, bill@bullingtoncapital.com. I can send it to you. You can play with it, or you can set up a phone meeting to discuss whatever you'd like to do. But anyway, the income is $7,750 on $100,000. So if you're 66, you're going to be 67, 12 months. You have to wait 12 months to turn the income on these. And income $7,750 off of $100,000, and that's for the rest of your life. Okay. Now, should the underlying investment, and I'm just going to tell you that it's highly unlikely that the underlying investment does better than that, but if it does, they're going to turn around and use that number to calculate what your income is, and your income will go up. Okay, but it cannot go down. So if you had another period like the last 10 or 15 years in the S&P 500, depending on when you started, and you were really unlucky, then it really doesn't matter with these types of products. They're going back to the schedule and saying, okay, how did the investments do? Did they do better than the guaranteed amount? Then they get the guaranteed amount. That's basically how that works. And I really like it. I like the fact that it's going to be incredibly difficult in the future to generate the types of returns that are being offered on a guaranteed basis today. I think you're going to have a really hard time keeping up with it. I think my portfolios will have a hard time keeping up with that. That's one of the reasons that I use it for a portion of the money. And I'm not telling you, I would. Nobody should be putting all of their money in anything, as far as I'm concerned. Yeah, maybe if you're 85 and you're not feeling too good, and your health is not real good, well, okay, then you might want to buy all CDs or treasuries at that point. But everybody else, if you think you might be, or you're not sure how long you're going to live, but you think it might be at least 5 years or so, all right. You need a stocks, bonds, and cash portfolio. The percentages are going to be different. It could be that this has a good place in that portfolio, but again, it's an individual thing. I've never met two people who are exactly the same. And it's one of the issues I think I struggle with in this practice is an awful lot of people think there's a magic pill or a magic wand out there. Everybody just needs to do this. This is it. This will cure everything. I'm still waiting. I'm still looking for that. It's only been a little over 30 years since I've been doing this. Actually, close to 35 now. Holy cow, I'm getting up there. But so anyway, I still haven't found that one-size-fits-all magic formula that is going to do everything everybody wants. What I think is really funny is married couples could be so different, and just kind of amusing actually how different their desires and understanding and risk tolerance is. That was an eye opener, and I get it now that I've been doing it all these years. But when I was younger, it used to confound me. I'm like, you mean people are not talking about this before they get married? And now that I'm older and wiser, I go, oh, okay, I know why. I see why. But anyway, going back to the 66-year-old is going to be 67 next year. Puts 100,000 in, gets $7,750 a year, guaranteed lifetime income. If gets hit by a bus, before it starts taking it, worst case scenario is all the money gets refunded. That's kind of good. Try to do that with a stock fund. You put your money in the stock fund, the market crashes, you have a heart attack and die. Your beneficiaries get what's left over, not the initial amount that you started with. Yeah. So anyway, one of the things I think is I don't know. It's challenging because if you're looking at this, if you called in or emailed and I sent you the link, you're going to go right to the page. but you're probably not going to remember what I said. And these do have to have some explanation. They're not as simple as a lot of other things are. And I feel bad about that. That's because it is such a good product in its space. It's not for everybody. Nothing for everybody. I was talking about that just a couple minutes ago. But in a lot of situations, this might be a really good alternative, especially if you're not very sophisticated, or especially if your spouse is not very sophisticated and you want to take care of them, or you want to make sure that they're taken care of should something happen to you. Should something happen to you. I guess I'm getting old. But one thing I got a question on this past week was taking distributions from IRAs that you inherited. And so I started looking up the data. And this is one of the reasons I really kind of like this field. It changes a lot. And there have been a lot of changes in the last couple of years regarding that. So I'm about halfway through reading all the reading I have to do to be able to, and by the way, that wasn't the only question. So looking up the answers to the questions for a client that I find it really interesting. And, it's not something that you kind of look forward to as far as, missing your family members and then having to step in and help somebody out, distribute the assets and what are the best ways of distributing. That's another thing that struck me. What's the best way to distribute money from an inherited IRA? Well, depending on who you are, what your relationship was on a family basis, on how you're related to that person, it's going to be very, very different. And I got about 50 seconds before I have to take a commercial break. So I guess we'll put this on hold until after these commercial messages. This is Bill Bullington right here on 1420. Stay tuned, and I'll be right back.
Sometimes I get that overwhelming feeling, so sad, the faces on TV.
You've heard the saying, all good things come to an end. Well, not always. Sometimes they just take a break. That's what's happening with Our Lady of the Wayside's car donation program after 24 years and 96,000 rides donated. Pretty amazing. Here's the story. The car lot's owner sold the property, making it impossible for car donations to be accepted at this time. According to the Wayside CEO, Terry Davis, the next right steps will be determined and communicated soon, so stay tuned. In the meantime, Terry and the entire team at the Wayside thank you for your continued support of the 450 individuals with developmental disabilities in the Wayside's care. And please take note, you can still support them by making a donation at thewayside.org.
Wallacadoodle, sewer repair. Now, you might be thinking there's nothing wallacadoodle about sewer line problems, and we're with you on that. But if you do need to repair your sewer, there's always a wallacadoodle solution. Most of the time, Wyatt Works can repair your sewer line with an advanced pipelining solution that eliminates the need to dig up your yard. Rather than replacing your clay sewer pipes, we'll line them with a smooth, incredibly durable epoxy, capable of lasting 100 years. The pipelining's completed in about a day with no mess in your yard, and it guarantees no more root intrusion or clogs. It's a permanent solution that works like, well, wallacadoodle. We even warranty it for life, and it comes with guaranteed upfront pricing and easy payment options. Now, most clogs can be fixed with our flat rate drain clearing, but if you called someone else for drain clearing and they want to dig up your yard and spend all week replacing your sewer line, well, call for a second opinion from the Wallacadoodle plumbers at
WyattWorks.com.
Do you ever find yourself saying, I need a vacation? Vacation Fixation can help. At Vacation Fixation, we specialize in all-inclusive trips and cruises to Mexico, the Caribbean, and Disney vacations. Why choose us? Our clients book through Vacation Fixation because they are frustrated with online trip brokers and timeshare scams. Whether it's a weekend getaway, a family trip, spring break, or honeymoon, Vacation Fixation will personalize a trip just for you. Want to know the hottest destinations in Cancun, Punta Cana, Jamaica, or Puerto Vallarta? Interested in room upgrades, beach reviews, or details about resort restaurants? How about finding a trip with a direct flight? At Vacation Fixation, we take all of your specific travel requests and shop our suppliers to find the best deal. What's the cost? Our suppliers pay us so you don't have to. Call 330-573-8147 for more details. Or you can visit our website at vacationfixation.com or check out the deal of the day on Facebook. Vacation Fixation.
Is it finally time to update your bathroom? Bath Planet, a division of Joyce Factory Direct, specializes in replacing and converting old showers and tubs into new, beautiful bathrooms in as little as one day. We have transformed thousands of bathrooms just like yours into a spa-like oasis that has homeowners excited to use their new bathtub or shower. Right now, all bath installations are 50% off. So call to schedule a free consultation with on-the-spot pricing. 440-243-5700 or visit JoyceFactoryDirect.com.
I heard the preacher talking about 3 wooden crosses upon a hill for every.
And we're back. Bill Bullington. I'm here every Saturday morning from 11 to noon. If you'd like to reach out to me, my website's bullingtoncapital.com. There's a contact us page there. Or you can just call 330-664-0700. And boy, I'll tell you, things really change fast these days. It is mind-boggling, all the products I see coming out each year. And it's like that big snowball that what started off as a small one, and when it was rolling down the hill, and now it's gigantic and it's got a lot of speed, and that rate of change is faster. So do the best I can to help you get ready for retirement, to make it through retirement. One of the bigger goals that we have is to try to help people be as comfortable as they can, earn as much as they can, while staying within their risk guidelines. And that's one of the things that's really difficult. Why? Well, because if you're going to get outside of savings accounts, you're going to get a lot of fluctuation. Not that that's necessarily bad, it's just the way it is. And you reach your goals? Well, if your goals are not 20% a year, you might be able to. If you're looking on your stocks to be able to average over a long time period, somewhere around 8 to 10%, that's great. I think that that's still possible. I don't think it's highly probable over the next 4 or 5 years, but I could be wrong. Yeah, I think the return's probably closer to 5 or 6%, just because of where the valuations on stocks are, which is one of the reasons that I keep talking about these annuities, because the rates on them are significantly higher than that. In fact, let's say you're 67 now, and you've already earmarked some after-tax money that you've already paid taxes on, or maybe you're drawing down an IRA, and you're going to do that for the next 3 years. You're just going to let it go all the way down, but you're still going to need income. So if you had $100,000 invested 3 years from now, at age 70, you'd get a $10,000 a year guaranteed income for lifetime through that particular product. That's pretty good. So when the other money runs out that you're spending, this one kicks in and is guaranteed for the rest of your life. That's a pretty good deal. If you turn it on just next year, or at the end of the first year, it would only be $7,750. So by waiting the 3 years, it went to $10,000. Pretty good. Now, I could go on and talk about a gazillion different examples, and what I'll do is on each show, I'll take a small amount of time, and I will go back and go over these in the future. But I'll also give you the the web address if you want to email me for it. It's kind of long, so I just copy it and send it back in an email. And you can click on there, and it'll let you come to this same page that I'm on, and you can put your own information in there. Or you can set up a phone call. We can talk about it that way. Or you can come into the office. We can always do that. So oftentimes I'll drive out and meet people. It depends on where they live. So lots of different methods of actually getting the information out there. And by the way, the reason I talk about this so much is that it's a good idea. I mean, for today, where we are, where the economy is, for not for everybody. I mean, if you're in your 30s or 40s, I would say, yeah, no, this is probably not. You don't want to do this. This is something that if you're above the age of 50, or if you're within a few years of retiring, maybe you're going to retire at 53 because you can. All right, well, then you might want to have some of the income guaranteed there, and then you're going to want to have some of the other investments for longer term, like stock investment. Yeah, you can have shorter term savings accounts. The yield's not quite as high on it, but that's okay. It's fulfilling a role. Not everything has to be producing at the highest levels all the time, because you would incur way too much risk doing that. Because the stuff that has the higher returns in the long run also has a lot of fluctuation. And in fact, I would tell you that the higher return you can expect to get, the higher the fluctuation is probably going to be. I'm just looking at some stocks. This is what really kills me. Here's a company that came up on a short-term momentum scan, and when you go back and look at it, I'm not sure who these guys are. Company's called ComScore, but in 2019, stock was $462 a share. It's been higher than that too. Today it's at $16.70. Wow, that's a 96% decline. Although it comes up on a short-term momentum scan, all that means is over the last 3 months, it's actually been doing fairly well. But that's typically where, if you're looking for longer-term investments, that's one method, is to look at what's moving right now. But you want to go back and then look at things like sales, profit margins, sales growth. I like consistency and that kind of stuff. So it's really a job. And it's one of the reasons that I've been using an exchange-traded fund. And it's so funny. People, the attitudes of the general public with exchange-traded funds are not very well informed. They think they're all the same in their funds, and anybody can pick those. Well, yeah, you can throw darts at financial pages, and that's essentially what you're doing. And if you look at just the returns, and you don't know how the returns were generated or why, that's dangerous. And that is really dangerous. Yeah, it's what gets everybody into trouble, because you look at the things that have just gone up the most, and you won't realize it. You'll say, "Oh, no, this is the best 5 and 10-year return that I've been able to find." And then you look at it, and it's all because they've been buying cryptocurrency stocks, and all those returns came in the last 12 months. And it lifted the 5 and 10-year averages because it's done so well. And, wash, rinse, and repeat. That's what it's like to be a financial advisor. You're constantly looking at that same story. I thought that story would change, because it was the same story it was when I started in this industry about 30 years ago. And I kept thinking, well, eventually they'll figure this out. And nope. Some do, very few. But the others, this is tough. This is what's really funny. See, I used to manage all the money myself, and now there are exchange-traded funds that do everything that I was doing, and there are actually multiple variations on that theme, which I think is great, because it gives you a little bit more diversification. And So I really like the fact that these funds are out there. I just find it's kind of sad when people don't understand what's actually in the funds that they're investing in. They don't know. They can tell you, oh well, the 5 and 10 year return on it, as if that's meaningful. I noticed you didn't come to work today driving backwards, looking in your rearview mirror to tell you where how to get to where you're going. That's basically what you're doing when you rely just exclusively on that. So, but it's just the way it is. I've accepted that a long time ago. But anyway, if I were interested in looking at some of these individual stocks, I would probably be looking at UEIC. That's Universal Electronics. There are profit margins in electronic devices can be extremely low, especially when you're coming to the end of a patent in a particular product, and everybody else then is going to be allowed to make the same product without having to pay for all the R&D that you paid. So I'm not sure exactly how high quality that one is. These are just the scans that came up over the past couple of days, and I go down through it. I didn't see anything that I thought, wow, that one really looks good. Here's my definition of something that looks good. It's moving up fairly quickly. On the day that it makes the scan, the volume is above its average daily volume over the last 90 days by about 50% or so. Now, you're going to have a screener, stock screener like the one I have to do that. And there's a software company or a software package called TC2000 that does that. You can set it up to screen specifically for that. So and you can put in valuations, you can put in price movement. What I like to see is, like, here's a bank, okay? This bank hasn't even been around that long. In 2021, it started trading. Bank share price went from $13 up to about $21, and then started crashing. And it comes down all the way to $7.63 earlier this year. Well, now it's at $14.31, and a lot of people go, "Oh, it's already up 100% from the bottom. I don't want to get down." Yeah, but it's still below where it was. It was $22, down by about a third from where it peaked back in 2022. The volume was above its average daily volume. The share price went up fairly significantly, about 4.5% in one day. It closed right near the end of that day, or right near the high of the day. Those things, if you keep looking at charts over time, are actually pretty attractive. So then I go and look at, okay, what's this thing? What's the valuation on it? And I like the price to sales ratio. And for banks, I'm going to tell you that the average is probably right around 3. I know it is, actually, because I've been doing this for a long time. This one's at 1.62. Okay, so not only has it got momentum, it's got a low valuation, and that's kind of a good thing. And it probably doesn't get a whole lot better than that. I mean, you could go and dig into the financial statements and see if they've got any red flags. We'll have to talk about that on a future show. But if you're looking at this as a trade, which it qualifies for because it's moving up so quickly and the valuation is so low. So if it's a trade, that's something where I would buy it at 14. It closed at 14.31. I'd put a buy order in. I'd put a 10% trailing stop loss, or not a trailing stop, but 10% from the initial purchase price. That would be my initial stop loss. And then the trailing stop loss, you could use anywhere between 15 and 20%. And that's what I used to do for a long time. And it was very, very effective. You typically had more losing trades than you do winning trades by a lot. And people wonder, well, how do you make money? Well, how does a guy make $90 million a year playing professional baseball when he strikes out 7 out of 10 times? It's because he's successful 3 out of 10 times. It's the same thing with the stock market. Yeah, you only need a small number of big winners to make this profitable, and that's probably what you're going to get. So it's not for everybody, believe me. I don't do nearly as much of this as I used to. I am always kind of surprised, though, when I see one of the stocks that I've known for a long time that comes back up. I just got the information. I only have about 60 seconds here. So I'll hit you one last time with this. If you hear anything on this show you'd like more information on, just go to my website, bullingtoncapital.com. And again, this is Bill Bullington. I'm here every Saturday morning from 11 to noon. I appreciate all you guys that have been listening over the years and all the nice emails that you've been sending. That's great. Happy holidays. And I will talk to you again next year, which is next Saturday.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
The preceding program has been paid for by Bullington Capital Management, LLC.